Broadcom is arguably the best dividend growth stock of the last decade. And with the latest developments in AI, the share price has been on a tear. But is this technology giant a dividend growing beast? Or is it just a part of the AI bubble? This is what we will explore today. Before we start, let me just save you some time. In this video, I will talk more about the financial side of the business than the tech side. The reason is that I am not a tech person, and it would be dishonest on my part to pretend I understand every little aspect of the company's business, because frankly, if you are not a tech professional, you probably don't know a lot of these words you see on the screen either. So if you're expecting an in-depth tech review, you might want to skip the video. The company was founded in 1961 as a semiconductor division of Hewlett-Packard, but has undergone significant transformation over the years. Through a series of mergers, acquisitions, and changing of names, Broadcom became one of the leading technology companies that enable us to have the internet as we know it. A lot of people might not have heard of the business as it doesn't have some huge consumer-facing product like Facebook, Google, or Amazon, but in fact, according to the company's website, 99% of all internet traffic crosses at least one Broadcom chip. Usually, a person would be able to get a hint about what the company does from its slogan. But that won't work here, because in Broadcom's case, they simply tell us they connect everything. And while that might be extremely vague, it is actually true. Broadcom creates chips that allow our devices to communicate either through wireless communication like Wi-Fi and Bluetooth, or through wired networking like Ethernet. The company provides crucial chips for data centers, cable modems, industrial and automotive electronics, and a lot of other industries. That part of the business is under the semiconductor division, which is one of the two segments of the company, with the second one being infrastructure software. The infrastructure software segment deals with cloud infrastructure, cybersecurity, and a lot of other industries. Broadcom has experienced a significant rally since AI exploded into the mainstream in late 2022 and is up more than 200% along with other semiconductor stocks due to the mission-critical nature of its products for the AI revolution. Speaking of AI, there has been an explosion of spending on AI-related technologies by big tech companies and AI startups. Broadcom reported an increase of AI revenue with 280% year-on-year, and this is expected to keep rising in the future. The positive side here is that the companies which are the big AI-related spenders also have the deepest pockets in the world: Microsoft, Alphabet, Amazon, Meta. And they all need Broadcom's products. On the negative side, having such a few very large customers is a dangerous situation, because some of these companies might decide to stop using products of third parties and start manufacturing them themselves. For example, Apple already had made such an announcement in the past when the iPhone maker said they will start replacing Broadcom's chips with ones it makes itself. If a few more of their largest customers decide to do the same, I'm not sure what exactly is Broadcom's mode when it comes to most of their technology. I'm not competent enough to understand their products in depth, so I would leave that conclusion to someone who is an engineer. But to me, this is something every investor in the company must consider. A huge driver for Broadcom's business, in my opinion, will be the growth of the Internet of Things. For those who don't know, this is basically the connection between the different devices that exchange data between themselves and the cloud. For example, your refrigerator talking to your air conditioner, or something weird like that. This market is projected to grow at 10.5% in the next years, and bearing in mind that this is exactly Broadcom's specialty, I expect them to capture a big chunk of that. If you're getting value out of this video, press the like button and subscribe to the channel with the notification bell so you get notified about my new videos instead of letting the algorithm decide whether to show them to you. Alright, let's get to the exciting part for all of us investors, the financial metrics of the company. Unless you are a tech nerd, then you are more excited by this. I will be using seekingalpha.com for that purpose. The first thing I want to pay attention to is the gross profit margin. This company boasts an exceptional 74% profit margin, which is 51% higher than the average for the sector. The gross profit margin is an important metric that shows you the competitive moat a company has. It is basically what the company sells its product or service for, minus what it costs the business to produce it. Usually companies which are pressured by competition will get their margins squeezed in order to compete on price, so I have always used that as a barometer for the business competitive mode. Broadcom's high profit margin leaves them plenty of cash to reinvest in the business or to distribute back to shareholders. The reason for this high gross profit margin is that Broadcom has the so-called fabless model, where they only design the chips but don't manufacture them themselves. Instead, they outsource the manufacturing process to companies like TSMC in Taiwan and other places. This allows them to retain billions of dollars, which they otherwise would need to spend on one of the most expensive and sophisticated equipment in the world. As an example, take a look at Intel's gross profit margin, which is a company that manufactures the chips themselves. Also, TSMC, which manufactures the chip for companies like Broadcom, Nvidia, AMD, and others. We're talking between 40 and 80% higher profit margins. The levered free cash flow margin is pretty good as well, standing at 47.5%. This is the cash left for the company after all expenses and obligations have been deducted from its revenue, and is basically what fuels the dividends or the share repurchases. Broadcom's debt situation, however, doesn't look as good. The total liabilities as a percentage of the total assets are 60%, which isn't a disaster, but it's quite high for a high-margin technology company. When we compare the debt to both the assets and the earnings, it is also quite high for the sector. However, that can be explained with the recent acquisition of VMware, for which Broadcom paid $69 billion, with $28 billion of it in debt. You can see how the debt jumped substantially from October 2023 to the last report, from 37 to 71 billion. Broadcom has a history of successful acquisitions, and besides, the CEO said in the last report that the integration of VMware is going very well, so in my opinion, the higher debt isn't a cause for concern for now. Moving on, the company's growth in the past decade has been impressive. Honestly, I don't remember seeing such numbers in my recent memory of analyzing companies. Revenue, net income, levered free cash flow have all grown with over 30% annually for the past decade. This is insane. The free cash flow per share of the company has increased with almost 1300%, which is fantastic. It shows you that Broadcom is a true free cash flow machine. By the way, if this is a bit over your head and you want to start investing or increase your investing knowledge, then I invite you to my free investing masterclass, for which you can find the link in the description. Thousands of people have already watched it, and the feedback has been overwhelmingly positive, so I'm sure it will be helpful to you as well. When it comes to Broadcom's free cash flow, the fact that it has been growing like crazy in the past decade is what's behind one of the most loved by investors features of the company, the dividend growth. The business is one of the most impressive dividend growth beasts I have ever seen. It has grown its dividends with 34.5% annually for the past 10 years, 16% for the past 5, and 13% for the past 3. You can see the growth going from $1.23 per share in 2014 to $19 per share in 2024. This is an extraordinary achievement, and it makes Broadcom one of the best dividend growers out there. But the question is, can this continue? And in my opinion, the answer is no. Here is where I see a lot of people getting trapped in the type of thinking that projects this growth to infinity. Then this gets them excited because they start imagining what their income could be in 30 years. However, the real world doesn't work that way. There's an old saying that trees don't grow to the sky, and I have actually made a whole video about this. In short, like everything in nature, including trees, the bigger a structure grows, the harder it is for it to grow with the same percentages. For example, it is very easy to double a business when it is doing 100K a year. Try doubling a business like Coca-Cola, which is doing tens of billions and is 150 years old. I will explain what I mean with numbers right now. When you see Broadcom's dividend growing at 34% a year, like it has on average for the past decade, and you think this will continue, here is what needs to happen. Since the dividend comes from the company's profits, we will need to make a calculation about the company's earnings related to its price. Broadcom's forward earnings per share is $47.96 and the dividends are $21. Let's assume they decide to distribute 100% of their earnings as dividends, giving them 100% payout ratio, which is not healthy, but I'm doing it in order to maximize the dividends, play the devil's advocate, and also for easy math. So that puts the dividend at $47.96 per share as well. In order for that dividend to grow with 34.63% per year in the next 20 years, as it has for the past 10, it will have to be $18,353 per share in 20 years from now. Obviously, if they want to keep paying it, they have to grow the earnings at least as much, if not even slightly more. This means Broadcom will have to have earnings per share of $18,353 in 20 years. And let's assume the price to earnings ratio, which is the multiplier for the price of the company, stays the same at 35.57. This will mean that in 20 years, Broadcom's price per share will have to be $652,816. And now let's multiply that by the number of shares to see the total company market capitalization. Broadcom has 465 million shares. So we multiply 465 million shares per $652,816 per share and we get... Okay, I just broke Google's calculator. Let's ask ChatGPT what that number is. So basically Broadcom's market cap will have to be $303 trillion and $659 billion in order for the dividend to keep growing at the same pace. Just to give you an idea what that number means, as of January 1st, the total USA stock market worth was $50.8 trillion. So Broadcom needs to be 6 times that. Also, Broadcom will need to be worth more than the projections for the entire world GDP in about 2 decades from now. You can see the obvious problem here. It is impossible, due to the laws of physics, for that trend to continue. And it is evident in the dividend growth slowdown in recent years. As you can see, it went down from 34.63 to 16 to 13% in the span of the past 10, 5 and 3 years. So all the people hoping to buy Broadcom and get their dividends increased with 30% per year in the next decades, I will have to disappoint you, but it is just impossible to achieve. Speaking of stocks that have increased their dividends, if you would like to get my favorite 4 stocks and ETFs report, you can do that in the link in the description. The report is free and will be sent directly to your email address. Moving on to Broadcom's valuation. The stock has gone up with 270% at the time of recording this since October 2022. At the same time, the free cash flow per share almost hasn't moved, going from $39.15 to $42.39. The overall levered free cash flow has had an impressive growth of almost 48% in the past 1 year, and the revenue went up with 21.62%. But this is nowhere near what the price has done. Does that mean that the price will go down soon? Not necessarily. The market is a forward-thinking machine, and no one knows how much future growth has already been priced by the millions and millions of market participants. However, you need to be aware of the fact that until now, the price has went up way ahead of the fundamental. Broadcom is a great company and one of the best dividend growth stories I've seen. However, make sure you don't project infinite growth to the sky or chase performance that has already been priced in due to fear of missing out. If you want to see a more detailed breakdown of why it is dangerous to project such growth for decades and decades ahead, check out this video I did on this extreme type of dividend growth investing, which I already mentioned. I will see you there.